All right, let's get right into it. When you hear the name Warren Buffett, you probably think of just, incredible wealth. But his real story isn't about getting rich quick. Actually, it's the total opposite. For more than 60 years, he built a massive fortune by doing what almost no one else was doing. He proved that in the super-fast world of Wall Street, maybe the most powerful strategy is to slow way, way down.
I mean, listen to that. Forever. In a market where trades are happening in nanoseconds, that one word sounds, well, it sounds kind of crazy, right? But this isn't just some catchy line. It's a complete rethinking of the entire game. It turns investing from this frantic race into a patient, deliberate waiting game.
So that's the big question, isn't it? How does a philosophy that's basically built on doing almost nothing become one of the most successful financial strategies in the history of the world? Well, to figure that out, we've got to go back to the very beginning. Before we can even get to the legendary investments and all the billions of dollars, we really have to understand the foundation, these simple but really powerful rules that have guided every single decision the man has ever made. This timeline really shows you just how early it all kicked off. I mean, Warren Buffett was no late bloomer. He bought his very first stock when he was just 11 years old. But the real game changer, the critical moment, was in college. That's when he studied under his mentor, Benjamin Graham, the guy who would give him the single most important idea of his entire career. And here it is. It seems so simple, but this right here is the engine behind absolutely everything. See, price is just the number on the sticker. It's what flickers on the stock screen. But value is what that company, that thing is actually worth. So the whole goal is to buy something for less than its true value, and then you just wait. And that core idea leads directly to his two legendary rules. This tells you everything. His strategy isn't about chasing some huge risky payday. It's all about protecting what you have. By focusing on not losing, the winning over a long period of time just kind of takes care of itself. It is a fundamentally defensive way to think. Okay, so we've got the theory. But how does this defensive, patient mindset actually translate into making multi-billion-dollar decisions? Let's take a look at how these simple rules built some of the most iconic investments of all time. Let's start with Coca Cola. Back in 1988, Buffett saw a business that was just incredibly easy to understand. It had a brand that was recognized on literally every corner of the globe, and crucially, it had the power to raise its prices without scaring off customers. He wasn't betting on some short-term fad. He was buying a piece of global culture itself. And then he just held on. Now, for decades, Buffett famously stayed away from tech stocks. He'd always say, "I just don't understand them." So you can imagine when Berkshire Hathaway started pouring billions of dollars into Apple in 2016, people were stunned. Had the master finally changed his own rules? Nope, he hadn't changed a thing. He just saw what everybody else was missing. He looked right past all the silicon chips and the software code and saw the iPhone for what it really was, an absolutely essential part of modern life. He saw a consumer product with the most intense, sticky brand loyalty he'd ever seen. He wasn't buying the tech, he was buying the ecosystem. And the results of that bet is just staggering. Today, Apple isn't just another holding. It is the largest single investment in Berkshire Hathaway's entire portfolio, and by a massive margin. It's perfect proof that his timeless principles can apply even to a modern tech giant, sitting right there next to his other longtime favorites like Coke and American Express. You know, the long-term results really do speak for themselves. This wasn't just a lucky break. That huge gap you see between Berkshire's performance and the general market, well, that's the real, tangible value of patience. It's a perfect picture of the raw power of compounding, the classic tortoise just absolutely crushing the hare over decades. But here's something that is just as important as all his wins. Buffett's legacy isn't built on him being perfect. Far from it. It's built on him being brutally honest, especially about his failures. He truly believes you have to own your mistakes, out loud, so you can learn from them. Let's just look at a few of these lessons. With Dexter Shoe, the mistake wasn't just buying a bad business. It was paying for it with his own incredibly valuable Berkshire stock. A hard lesson in not overpaying. With IBM, he flat out admitted he just misjudged how fast technology was moving. And with the airlines, he broke his own long-held rule against investing in them, only to have a crisis remind him exactly why he had that rule in the first place. Every single failure was like a masterclass that just made his core philosophy even stronger. So if it's not about being perfect, Then what is the ultimate advantage? What's the secret ingredient that pulls all of this together? Well, it goes a lot deeper than just numbers on a spreadsheet. First off, you simply cannot tell Warren Buffett's story without talking about his partner of over 50 years, Charlie Munger. Munger was the one who really pushed Buffett's thinking to the next level. He's the one who helped him evolve from just buying any cheap cigar butt company to focusing on buying truly wonderful businesses, even if it meant paying a little bit more for them. And this whole philosophy isn't just for investing, it's for his life. This is a man who is a billionaire many, many times over, yet he still lives in the exact same house he bought back in 1958. He values simplicity, honesty, and real long-term friendships like his famous one with Bill Gates. It all comes from that same core belief in long-term value over short-term flash. When you boil it all down, his greatest advantage was never some secret formula or some insider tip. It was his temperament. It was having the emotional discipline to avoid the herd mentality, to stay calm when the entire market was panicking, and to stay patient when everyone else was getting greedy. And this, right here, is just the perfect summary of his entire career. He didn't try to beat the market at its own frantic game of speed. He just decided to play a totally different game, a game that's measured in decades, not in days. And he won. So that kind of leaves us with one final thought. In our own lives, in our finances, our careers, our relationships, what would happen if we started applying that forever mindset? What is the one thing that's so valuable to you it would be worth holding on to for the long run?